Today, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing it to 2 to 2.25%. This action reflects the strength we see in the economy and is one more step in the process that we began almost 3 years ago of gradually returning interest rates to more normal levels. Looking ahead, today's projections show gradual interest rate increases continuing roughly as foreseen in June. The median of participants' views on appropriate policy through 2020 are unchanged since the June meeting. These projections play an important role in our work. My colleagues and I believe that it's useful to communicate our views on likely prospects for the economy and for policy. We are well aware, however, that the economy regularly surprises and that even the most carefully constructed projections are highly uncertain. The projections about the appropriate path of policy assume that the economy evolves broadly in line with the projections for growth, employment, unemployment, and inflation. If the economy were instead to falter, lower interest rates would be appropriate. Conversely, if inflationary pressures were to rise more than expected, higher interest rates would be appropriate. Right now, as our statement indicates, risks to the economic outlook appear roughly balanced. Readers of the FOMC statement likely noted that the committee dropped a sentence that indicated that the stance of monetary policy remains accommodative. This change does not signal any change in the likely path of policy. Instead, it is a sign that policy is proceeding in line with our expectations. We still expect, as our statement says, further gradual increases in the target range for the federal funds rate, and this expectation is reflected in the projections that I just discussed. Looking ahead, today's projections show gradual interest rate increases continuing roughly. Our economy is strong. Growth is running at a healthy clip. Unemployment is low. The number of people working is rising steadily, and wages are up. Inflation is low and stable. All of these are very good signs. Of course, that's not to say that everything is perfect. The benefits of this strong economy have not reached all Americans. Many of our country's economic challenges are beyond the scope of the Fed, but my colleagues and I are doing all we can to keep the economy strong, healthy, and moving forward. That is the best way we can promote an environment in which every American has the opportunity to succeed.
Given the lags of monetary policy, I want to know how you think about ending the tightening cycle.
Both household spending and business investment are expanding briskly, and the overall growth outlook remains favorable, and several factors support this assessment. Fiscal policy is boosting the economy. Ongoing job gains are raising incomes and confidence, and overall financial conditions remain accommodative. These conditions are consistent with our summary of economic projections for this meeting. The median of committee participants' projections for the growth of real GDP is 3.1% this year and 2.5% next year. Job gains averaged 185,000 per month over the last 3 months, well above the pace needed in the longer run to provide jobs for new entrants to the labor force. The unemployment rate stood at 3.9% in August and has been near that level since April.
The researchers at the European Central Bank this week put out a paper saying that
and I think that that's an assessment of where policy will need to be some years down the road.